If you walk into a grocery store and the shelves are empty, that is bad. That means there is a shortage. But if you walk into a grocery store with a truck full of apples and the owner looks at you and says, "I have no apples to sell, but I also refuse to buy your apples," then you know something is fundamentally broken in the brain of the economy. In a functioning market, a business is either buying or selling. Usually both. That is how commerce works. That is how the wheels turn. But today, Thursday, January 22nd, 2026, the wheels of the United States precious metals market didn't just stop turning, they fell off the axle. We have received a document this morning that is arguably more terrifying than the price charts we have been analyzing all week. It isn't a government proclamation. It isn't a bank report. It is a simple trade sheet from one of the largest wholesale distributors in the United States. These are the companies that sit between the US Mint and your local coin shop. They are the pipelines of the physical market. And the trade sheet is a paradox. On the sell side, it says sold out. We expected that. But on the buy side, the price they are willing to pay you for your metal, multiple major products are listed as no bid. No bid. Let's translate that into plain English. It means that if you call this wholesaler with 1,000 ounces of silver that you want to sell, they will hang up the phone. They do not want it. How is this possible? Silver is trading at $95 an ounce. The demand from the public is up 400%. The industrial demand from Samsung and Tesla is insatiable. By all laws of economics, these wholesalers should be begging you for your metal. So why are they refusing to buy the most valuable asset on the planet? The answer is not a lack of demand. It is a lack of capital. Welcome to the Dollar Watch. Let's look at the numbers. To understand why the pipeline has frozen, you have to understand the business model of a wholesale bullion dealer. These companies are not investors. They are not stackers who buy silver because they believe the dollar is going to collapse. They are logistics companies. They operate on razor-thin margins. They buy a bar for spot plus $1 and they sell it for spot plus $2. They make their money on volume. Because their margins are so thin, they rely on massive credit lines to keep the metal moving. They borrow money from major banks to buy silver from the US Mint or the refiners, and they pay it back when they sell to your local coin shop. But today, those credit lines are maxed out. The banks that lend to the wholesalers have shut off the tap. This no-bid status is the financial equivalent of a heart attack. The blood, the cash, has stopped flowing to the organs. If the wholesaler cannot borrow money, they cannot buy your silver. It doesn't matter if they have a line of customers waiting around the block. If they can't write the check to you, the trade doesn't happen. This creates a frozen market. Imagine you are a local coin shop owner. You have customers screaming for silver. You call your wholesaler to order more inventory. They say, "Sorry, we have nothing." Then a customer walks into your shop and says, "I want to sell my silver." You think, "Great, I can buy this and sell it to the waiting list." But to buy it, you need cash. If you are a small shop, you rely on selling back to the wholesaler to manage your cash flow. If the wholesaler says no bid, you are stuck. You can't offload your excess inventory to raise capital. The entire chain is seizing up, but why are they out of cash? Silver went from $25 to $95. These guys deal in silver. They should be making record profits. They should be swimming in money. So why are they insolvent? The answer lies in a financial strategy called hedging. It is a strategy designed to protect them, but in a vertical market, it becomes a suicide pact. The banks that lend money to these dealers force them to hedge their inventory. When a wholesaler buys 1,000 ounces of physical silver to put on their shelf, they immediately log into the Comex and sell, or short, 1,000 ounces of paper silver. On paper, this looks perfect. If the price of silver goes down, their physical inventory loses value, but their short position makes money. They are delta neutral. But what happens when the price of silver goes up? And not just up a little bit. What happens when it goes vertical? When silver goes from $25 to $95, the value of the physical silver sitting in their warehouse skyrockets. They are sitting on a gold mine. But, and this is the fatal flaw, Their short position on the Comex explodes in their face. For every dollar the physical metal gains, the paper short loses $1. Now, you might say, so what? It is a wash. In the long run, yes. But in financial markets, you don't survive to the long run if you run out of cash in the short run. This brings us to the margin call. The gain on the physical silver is unrealized. It is just a number on a balance sheet. The dealer cannot access that money until they actually sell the metal. But the loss on the paper short is realized every single day. The Comex does not wait. Every night, the exchange calculates the loss and demands immediate, liquid cash. As silver rocketed to $95, these wholesalers were getting hit with margin calls amounting to hundreds of millions of dollars. They had to wire cash to the exchange every morning just to keep their hedge open. They drained their bank accounts. Then they drained their credit lines. And finally, they hit the wall. This explains the no-bid status. Why can't they buy your silver? Because every available dollar they have is being sent to the CME group to pay for a short position that was supposed to protect them. They hedged themselves into insolvency. In part 2, we dissected the destructive hedge. Now, we must look at the banks. Why are the major lenders pulling the plug right when business is booming? It comes down to risk models. To you and me, silver going to $95 is a sign of value. To a bank risk officer, it is a sign of volatility. And banks hate volatility. When an asset creates a vertical line on a chart, the bank's risk model labels it a bubble. It labels it toxic. The bank looks at the wholesaler's inventory, which is now worth 4 times what it was a year ago, and they get nervous. They worry that if the price crashes tomorrow, the collateral backing the loan will evaporate. So they increase the haircut. A haircut is the percentage of the asset's value that the bank discounts for safety. When silver was $20 and stable, the bank might lend 90% of the value. Now that silver is $95 and volatile, the bank might only lend 50%. This creates a collateral crunch. Even though the dealer's inventory is worth more, they can borrow less against it. The purchasing power has been destroyed by the bank's fear. But there is a simpler mathematical reason for the freeze: the capital constraint. Let's say a wholesaler has a fixed credit line of $100 million. When silver was $25 an ounce, that $100 million could finance 4 million ounces of inventory. That kept the supply chain flowing. But today, with silver at $95, that same $100 million can only finance roughly 1 million ounces. The capacity of the wholesale industry has shrunk by 75% just because of the price increase. The pipe has gotten smaller. This means the wholesaler can only do 1/4 of the business they used to do. They can only buy 1/4 of the metal. They can only serve 1/4 of the customers. And because they are already maxed out paying margin calls to the Comex, they have zero room to maneuver. They are bumping against their credit ceiling every single minute of the day. We have arrived at the casualty phase of the crisis. We must look at the victims. And I am not talking about the banks. They will get a bailout. I am talking about the Main Street victims, the small businesses, the local coin shops, the independent online dealers. They are facing an extinction-level event. The credit freeze is the asteroid. The industry wipeout is the dust cloud that follows. Think about the business model of your local coin shop. They operate on cash flow. They buy silver from the public in the morning, and they sell it to the wholesaler in the afternoon to lock in a small profit. They are a pass-through entity. But on Thursday, January 22nd, the pass-through mechanism stopped working. When the wholesaler went no bid, the local dealer lost their exit strategy. They are now holding inventory that they cannot flip. Their cash is tied up in metal, and while holding metal is great for wealth preservation, it is terrible for paying the rent, the electric bill, and the payroll. You cannot pay your employees in silver eagles. You need dollars. If the local dealer cannot convert their silver back into dollars because the wholesaler is insolvent, the local dealer becomes insolvent. It is a chain reaction. We predict a massive wave of bankruptcies and consolidations. In every financial crisis, the big eat the small. The too big to fail entities will survive and absorb the market share, leaving us with less competition and higher premiums. Before we talk about the future of the market, I need to stop and have a direct conversation with you, the viewer. We are watching a collapse of trust in the financial system, but there is also a collapse of trust happening right here on this platform. We are the Dollar Watch. We have built this community on hard work and deep research, but unfortunately, we have seen a massive explosion of copycat channels. They are using our name. They are stealing our scripts. They are trying to monetize your fear without doing the work. I want to be absolutely clear. We have only one channel. We are only on YouTube. We do not sell crypto on Telegram. We do not have a WhatsApp group where we ask you for money. The other people using this avatar are scammers. If you value the truth, help us signal boost the original source. Report the copycats. Share the link to this channel. We are fighting a war for truth in a market full of lies. Now let's return to the wipeout. The destruction of the dealer network has a secondary effect that is even more dangerous for the retail buyer. It destroys price discovery. In a healthy market, you have thousands of dealers competing for your business. This competition keeps the premium, the price over spot, in check. But if the competition dies, the surviving dealers have a monopoly. This connects back to the $120 street price. Why are premiums exploding? Yes, it is the shortage, but it is also because the competition is dying. The surviving dealers know they are the only game in town. They can widen the spread, they can pay you less when you sell, and charge you more when you buy. We could see a scenario where the dealer sells you an ounce for $130, but only offers to buy it back for $90, a $40 spread. They have to price in the risk that the wholesaler might default on them. This friction kills the liquidity of silver for the average person. It makes it hard to trade. And ironically, that is bullish for the price. When an asset becomes hard to trade, people hold it tighter. The velocity of silver drops to absolute zero. The silver sitting in private safes is effectively off the market. It is not coming back. The recycling supply, the silver from grandma's silverware or old coins, is about to fall off a cliff because the mechanism that recycled it is broken. So where does this leave us? The wholesalers are maxed out. The local dealers are closing. The credit lines are frozen. The centralized market structure has failed. But markets abhor a vacuum. If people want to trade silver and the shops are closed, they will find another way. We are about to witness the birth of a new market. A market that is older than the Comex, older than the dollar, older than the United States itself. We are returning to the peer-to-peer market. We are entering the era of disintermediation. That is a fancy word for cutting out the middleman. For the last few decades, we relied on the system to facilitate our trades. We paid them a premium for the convenience. But now the convenience is gone. The middleman is insolvent. And when the middleman dies, the buyer and the seller have to find each other directly. In a peer-to-peer market, the price is not set by an algorithm in Chicago. It is set by the two people standing in the room. It is highly probable that the price in a private setting will differ significantly from the screen price. Reports from private forums suggest that physical clearing prices are already converging on $130. Why? Because there is no bid-ask spread in a private deal. There is just the price. This creates a gray market. It is a market that exists outside the banking system, outside the tax reporting thresholds, and outside the visibility of the regulators. It is a market of pure privacy and pure liquidity. The wholesale collapse is actually the best thing that could happen to the price of silver in the long run. Why? Because it kills the leverage. When a wholesaler buys silver, they short it on the Comex. That suppresses the price. But when you buy silver from your neighbor, nobody shorts anything. The metal changes hands, and the paper market is completely bypassed. We are looking at a permanent bifurcation. The paper price on the Comex may diverge from reality, becoming a secondary indicator used only for institutional settlement. Meanwhile, the street price, the real price, faces significant upward pressure. That $50 gap between the screen price and the street price is the trust premium. It is the price you pay to know that your wealth is real. We are watching the remonetization of silver in real time. It is ceasing to be a financial asset and becoming a currency again. And currencies don't need a dealer, they just need acceptance. At $95, silver is accepted. At $130, it is coveted. The system has failed. The credit lines are cut. But your vault is full. Those who prioritized physical possession early on are now watching this crisis from a position of safety. The middleman is dead. Long live the metal. Thanks for watching. Subscribe to the Dollar Watch. I'll see you in the next video.